Okay, so welcome to, what week are we up to? 4? Week 4. So we're almost a third of the way through the course. Yay! I have to, the university has asked me to show these, which is, I don't know if you've ever seen it, but we now have an early student feedback survey that is like 4 questions or something that you're supposed to fill in. So if you can, please fill them in. I don't know, we have 3 questions in it, and or there's 4 questions altogether, and I'm not exactly sure why they use this survey because students ask for things in the survey that I can't actually change. Like, I'd like different sorts of assessments. Unfortunately, I get locked into those like about a year in advance, so I have to go to a committee, and the committee has to assess whether I want to change something, and then it has to go to the faculty level, and then another level. So I just fill it in, I'll have a look at it. But if there's anything you really don't like, just send me an email. Oh, and don't make any threats or use any offensive language in these things, because somebody actually sanitizes them. So we looked at one for one of our colleagues the other day, and it said, so-and-so is words deleted. And words deleted. And should be more like so-and-so who is offensive language deleted. So if you do make a threat or something in your SFS, please note that the university will follow up on it. Even though it is anonymous, I can't see who is making those threats, but someone at the higher university level can access that. So it's best to be reasonably polite. And yeah, you could use strong language, just don't use swear words, because those are the ones that they like to bleep out. I don't know whether somebody actually reads them all or if they just use a filter, but something to about. Okay, what I'm going to start with today is a bit of a summary of what we should have done for last week. And I know that there was a lot of lecture videos to watch last week. There's a lecture video, plus there were 6 other little videos. I know it was a lot to watch. Last week, or this week, I suppose, for the homework prep, is the biggest week that you'll ever have to handle. Right? It was 2 chapters, and it's probably the steepest learning curve, but the stuff that we did this week for homework lays the foundation for the remainder of the course. So if you don't get a handle on it in the next couple of weeks, or it's still confusing, email me, ask me, for a consultation time, and I can help you out. Because if you can't get these things under control on your own, then you'll need some help to do it, because if you can't get this week and last week under control, it makes doing the second half of the course virtually impossible. Because if you don't have that basic understanding, everything will just seem like we're speaking a completely different language, and it will be really, really confusing. So I thought I'd start by and somehow my cough is much, much better. Though my son is now ill, and he's got the cough. But somehow I've managed to injure my neck from coughing. I have some form of neck strain from the cough, so I apologise for sitting down today. But I'm going to talk a little bit about where we are right now, and then I'm going to talk a little bit about where we're going to go today and next week, so you've got some context. All right, so I know that's not technically in your slides, but I think it's something that's worthwhile doing just to make sure that we're all on the same page. Okay. We know that we produce an audit report. All right. That's just a little document symbol. And I know that the audit report is really about the truth and fairness of the financial statements, which is another document. All right, so the audit report is on the financial statements, and we're trying to figure out, is it true and fair? Now this diagram will be slightly different to the one that I drew this afternoon, because I had a bit of an extra idea on the way up here. So my audit report is about trying to figure out whether my financial statements are true and fair, And we know that this whole bundle of information goes out to shareholders. Oh, I don't like that green. Let me adjust that. Okay. So, no, woo, undo. How do I do that? I want it, there we go. Whoa. Oh, what have I done? There we go. And I think now there we go. Ah, phew. Upgrade to the app and suddenly I don't know how to drive the thing. So our audit report and our financial statements go to shareholders and they use that for decision making. Okay? Now, to actually generate my audit report, I need to collect, let me change colours here, audit evidence. Okay. Because without evidence, I can't actually make an opinion. So evidence is really important. I need to, just like in a crime drama, to be able to prosecute someone for a crime, you need to have evidence. To be able to give our opinion, we as auditors need to have evidence. And where does that audit evidence come from? Well, it's going to come from designing an audit strategy or an audit plan. All right? So our strategy will tell us how to collect audit evidence. And it'll also, what we're going to focus on today is sort of what goes into that evidence strategy. So we're going to look at the sorts of procedures we might use to collect that audit evidence. And then the big question comes down to, how do I know what it means to be true and fair? All right? We know this idea of truth, but truth, you know, if you have a car accident, you've got 3 different witnesses, you could have 3 different perspectives on what is the truth. So the trick for us is we're going to use something called assertions combined with our audit evidence, and our assertions are actually going to be how we're going to determine what is true. Right, and this is this word we've never used before, so it's a little bit unusual. So we're going to apply our assertions and our procedures to generate audit evidence to come up with an audit report. Okay, now our audit strategy is based off our audit risk model. Oh, let's see if I can use the new math equation thing. Detection risk. This is a new function on the app that just came out the other day, so I'm really keen to see if I can make this work. Equals space. Oh, okay, here we go. I want nothing that, okay, this one I think. Inherent risk and control risk, oops, divided by detection risk. Oh, no, sorry, divided by audit risk. All right, that's not as neat as I thought it would be. So my audit strategy comes from my audit risk model, okay? So that's that bit here, that's our audit risk model. And the audit risk model is one of those things that's really counterintuitive. The idea of detection risk especially is something that tends to be very counterintuitive because it's the risk of not detecting a material misstatement. But my audit risk model says that the audit partner sets audit risk. Okay? My inherent risk and my control risk are actually assessed by the auditor. All right? I can't change my inherent and my control risk. All I can do is assess them at the client. Okay? Now, can anyone remember my detection risk and my inherent and control risk? Do these move in the same direction or opposite directions? Opposite. All right. So what's really important to remember is that these have an inverse relationship there. All right. Those two factors. So as risk at the client goes up, the more likely there are to be material misstatements within the financials, and therefore our detection risk needs to go down. And remember, detection risk is the risk of not detecting an error. All right. This is quite a tricky concept, which is why there's the introductory video on the audit risk model, and then there is the video called, it should be called non-detection risk. If you haven't seen those yet, I really recommend looking at those. So what we have is we know that we're going to use our audit strategy to be able to devise a plan to collect evidence to be able to generate my audit report. To find out whether my financial statements are true and fair, I'm going to introduce something today called assertions, and I'm going to learn about what procedures I can use to collect my evidence. So just like on those crime shows, there's like a special way to collect the fingerprint and to collect and analyze the blood sample, or to get, the DNA off the hair follicle or whatever it is. We have special procedures that we are going to learn how to use on how to collect audit evidence. Unfortunately, there are no special tools. There's no beating watermelons over the heads with various weapons to find out which one the killer used. It'll mostly be brain power. Now, the one thing that I haven't talked about from last week that I will add in is this idea of materiality. All right? Because I know that I'm looking for whether the financial statements are true and fair, but I know that it's impossible to find every 1 and 2 cent and $1 error. I'm only looking for errors that are material, that are important enough to impact my audit report. Okay, and we looked at those a little bit today. You're going to look at those a little bit in the Cloud9 case today. So where we're going to spend the majority of the semester is on, let me just change the color of my pen here. All right, where we're going to spend the majority of the semester is this bit here. All right, how do I design these procedures? For the midterm, you just need to know what sort of procedures are around and what the assertions are. For the final, you're actually going to be designing ways to collect evidence, all right, and actually executing that in the exam. So if you can't quite get a handle on it by the midterm, you need to really work hard on that, because otherwise the second half of the course just becomes like a totally different language that you just have no idea about what's going on. So that's what we're going to do today. All right. So I have the idea of evidence. Obviously, sorts of evidence we might think about. We've got the fingerprint. We're often looking for digital evidence or pieces that show us what might be going on. The reason I have this one here, picture of my son and that's green smoothie. So he thinks juice is spinach, kale, and apple juice. He doesn't like regular juice. I've only ever made mostly veggie juices. And so I gave him a juice in a cup, plastic cup, with a straw. He was sitting there drinking it. I went away to do something for like 2 minutes, and I came back, and he looked like this. And I said, "What happened?" He said, "I don't know." Or he says, "Nothing. Nothing happened." I think I said, "Oh, what's going on?" He goes, "Nothing." So I took the photo. I said, "You sure nothing?" He's like, But the evidence shows us otherwise. Right? The evidence showed us that somehow a whole lot of juice that was in a cup that has a lid on it ended up all over himself. I didn't manage to get a picture of the dog, who also was covered in said green juice. But then I need to use my powers of observation, of deduction, to try and figure out exactly what's going on. Yeah? And that's what we're going to be doing as auditors. We're looking at financial information and saying, does this look correct? Is there anything that feels unusual, that doesn't seem to reflect exactly what's going on in the company? So we use a lot of what we see, what we know about a company, about an industry, about how accounting works. Everything pulls together to try and identify those parts of the accounts that don't look right. Who has seen I think it was the Tom Cruise movie called The Minority Report? Anybody? Okay, so that must mean I'm really old. If you've not seen the Minority Report, it's coming back as a TV show. I've seen the pilot for the TV show. It looks pretty awesome. But the whole idea was that they had these people who could see into the future, right? They could see people committing crimes before they happened. And so the police used these 3 psychics to actually catch people before the crime was committed and then put them in jail. All right? That's sort of what we're doing without all the weird space guns and drugs and all sorts of other stuff. But we're trying to pick up incorrect information within the financial statements before it gets out to the public. All right? So we are that barrier to make sure that what goes to the public is the truth. So that's a really important role we have to play, and evidence is really crucial to doing that. So, what are we going to do today? We're going to do a few different things. We're going to look at assertions, which are going to be our ways to characterize whether something is true or not. We're going to look at different types of evidence, but what is going to be more important is looking at specific procedures. So this week for homework, there is a question about types of evidence, but what I've actually done in the homework guidance is rewritten the question to get you to think about it from a procedural perspective, all right? Because in terms of what's important for the final exam, it's this one and it's this one, okay? Textbooks do talk about types of evidence, but from a real-world perspective of actually practicing auditing, the thing that's more important is understanding these procedures, okay? So today you might notice that there's only really 28 slides. There's not a lot in today, but it is quite complicated. Okay. What the heck is an assertion? Who's ever heard of the word assertion before today? A few people? Last week, so we would have covered assertions a little bit last week, but it's not a word that you normally would associate with accounting or something that you would come across in everyday life. All right? So an assertion is a statement of fact. And so when management prepare their income statement, balance sheet, notes to the accounts, and they give it to you as the auditor, they say, this little document that we've prepared, all right, I'll change colour pens, let's do it in blue. So management say, look, here are my documents. All right, I've got my income statement, I've got my balance sheet. These here are what management think are true. So then it's my job as the auditor to actually, okay, that's meant to be like a spyglass, a little magnifying glass. That's very poor drawing. But it's my job as the auditor to look at the information they've provided and say, is that really the truth? Okay. Now, do you think managers want to paint themselves in the best light whenever they're talking to shareholders? Absolutely. Right? No manager ever says, yeah, I sort of did a shit job of running your company this year, but you should really still hire me next year. They want to put their best foot forward. They want to show financial statements that maximize their executive compensation. Okay? Has everybody done MDC or is doing MDC? Right? And Nicole will talk about designing compensation to align the incentives of executives with the incentives of managers. And for those people who haven't done MDC yet, hopefully when you do, she'll get to wear the Spider-Man outfit. I don't know if anybody is doing MDC this term, but Nicole actually turned up as Spider-Man because there's this whole idea that with great power as an executive comes great responsibility as well. I don't know where she got a Spider-Man outfit from, but she just walked in and it looked pretty cool. But when management say, here is my financial report, they're saying, this is my assertion on what I think is true. Okay, this is my perspective on the truth. Okay, so every time, every number, every sales line, every disclosure, every asset, every liability is their assertion about what is true. But how do I know if it really is the truth or not? All right. Just like when you might have a car accident and you have 3 different witnesses and 3 different people give 3 different accountings of what actually happened because everybody has a different perspective, then how do I know what the hell is true? Right? This is Kanye at the MTV Awards all over again. Hey Taylor, even though I know that everybody voted for you as the best video clip of the year, I think Beyonce's clip was the best clip of all time, and that is Kanye's assertion of what he thinks is true. So how do I figure out what the hell is the truth? Right? I certainly can't sit the CFO down and attach him to a polygraph or a lie detector test and ask him whether every number is correct or not. Is sales really $150 million? Have you lied on the accounts about have you undervalued liabilities? Were all of these expenses really incurred in this financial year? Impossible to do that. And I'm pretty sure our clients would be upset if you put them in an interrogation room with the hot light and deprived them for 12 hours of food and drink and then interrogated them on the financial statements. And similarly, the paper doesn't talk, right? You can't shake the financial statements and say, sales, are you really $150 million? Because the paper doesn't talk back. If at any point the paper does talk back, you need a break and you've been auditing for too long. But we need to figure out some way in which to test whether the financial statements are true or not. Some sort of characteristics of what is true. So we use the assertions, and they come out of ASA 315. And you might notice that ASA 315 comes up a lot. It's quite a large standard, but it's a really important foundation standard. And it says that I have to use assertions to determine whether there's a risk of error within the financials, and then I need to gather evidence for each transaction, account balance, or disclosure. It still doesn't tell me what the assertions are, though. It says you have to use these assertions. So, here we have our assertions, or as another way of putting it, let me just change colours on the pen. These are our characteristics of the truth. For numbers in the financial statements, anyway. This is not necessarily, the truth about everything and answers to all of the universe, which, of course, we know is the number 42. Has everybody seen The Hitchhiker's Guide to the Galaxy? Some people have. If you never have, apparently the solution to all answers and questions of life and why we exist within the universe, the answer is 42. It's a bit of a cult thing. If you've never seen it and you want to procrastinate, definitely hire The Hitchhiker's Guide to the Galaxy DVD. So to figure out whether something is true or not, we're going to use these financial statement assertions. These come out of ASA 315, paragraph A124. And we're going to use these as our characteristics of the truth. Now you'll notice that I've got a couple of different tables here, and the first one says transaction-related assertions. So transactions tend to fall into two categories. We tend to have revenues, and then we tend to have expenses. Okay. Now, where do I find revenues and expenses? Which sort of set of financial information will I find it on?
Income, revenue, expenses on income statement.
Yes, so they're on the income statement. All right. So my revenues and expenses I'm going to find on my income statement. So when I see here transaction-related assertions, you can think that this applies to the income statement. All right. Okay. So the first one, occurrence. Transactions and events have actually occurred. They're real. All right. Let me just change my pen here. Okay. So my occurrence is about making sure that things are real. Real customers sold real goods. My second one is completeness. Transaction events that should have been recorded have been recorded. Now a key word to think about this, or a word to think about it, or remember it, is that the word all. I want to make sure that all transactions were recorded. I didn't include only revenues and forget some expenses. I've included everything. Accuracy is about having the correct dollar amount recorded for the transaction. Cutoff is about recorded in the correct period. All right, I'll give you an example here. So let's say we've got our little timeline here. Let's have the 28th of June. Shrink that down so I can fit that in there. All right, so we've got our 28th of June, and then we've got our end of financial year here, which would be the 30th of June. All right, and then let's have another date. I'll pick the 3rd of July. And this comes back to the prereq test I had you guys do in week 1. Okay, so I've got my dates here. Let's say that I sell something here on the 28th of June. Right? Most times when you sell something within your system, here you'll go debit accounts receivable, credit sale. Yep. But what if the good isn't delivered until the 3rd of July? All right. Then I'm going to have a sale recorded in this financial year, whereas the AASB on revenue recognition said it should be in this year. Okay. So that's the cutoff idea, that we're recording transactions in the correct period. It doesn't usually have an impact for 340 days of the year, but usually 2 weeks before and after the end of financial year for most companies, there's a little tricky section where the accounting will automatically record a transaction, but the goods aren't delivered until the next financial period. And then the last one is classification down here, and classification is really all about my debits and my credits. All right, making sure that I'm debiting and crediting the correct accounts within my financial statements. When I'm making a sale, I go debit accounts receivable, credit sale. So for every item on my income statement, every income item, COGS, expense items, all of those items, I need to make sure that each one meets these 5 criteria to be true. Okay? An account is only true and fair and free from material misstatement if it meets all of these criteria. If it doesn't, if I can't prove that the sales really went to real customers, then I've got a misstatement that I might need to consider adjusting for or requesting management adjust in the accounts. All right? I'm going to hook you on these assertions from now until the day you graduate out of this course. All right? It's such an important concept that you really need to understand what they're all about. Now, anybody here work at an accounting firm or an audit firm? A few people? Just be careful. These are the assertions taken from the auditing standards. Some firms might have slightly different wording on these. So I know that EY, for example, doesn't use accuracy, it uses the word measurement. But it means the same sort of thing. So you might need to, if you're used to using your own audit firm or accounting firm terminology, just be really careful that in class and in exams you use the auditing standard terminology. Most firms are fairly well aligned with the auditing standards because they know that their people will have to go out and do the CA exams, etc., which uses this sort of terminology right here. All right. Okay, balance-related audit assertions. My balances, pretty easy. They're going to be my assets, my liabilities, and my owner's equity. And where am I going to find those? Where am I going to find these? Balance sheet. Oh, phew, thanks. Thank goodness. I was going to have to send you all back to John Tyler there. You guys all had John, didn't you?
Yeah.
John Tyler for intro, yeah?
I remember John.
And when you saw John last week, did he look a lot different than when you saw John the very first time you had him as a student?
He lost weight.
He's lost, like, pretty much an entire me. It's been pretty amazing. And he's been doing it through very strict diets and exercise. So, don't ever eat a cookie or a cake in front of John because he's likely to either murder you for it or just give you this nasty glare. Like, don't eat that delicious sugary treat in front of me. But with John and James and Prabhu and probably Matt Gross as well, you would have learned about the balance sheet. So my balance-related assertions relate to the balance sheet. Okay, so for every asset, liability known as equity, I need to check that they match up with these 4 components. Number 1, existence. Again, this is more of, is something real? Right? Easy with a physical asset, a bit more difficult with an intangible asset. The second one, do we have rights or obligations? Now, the rights one tends to be more rights to recognise assets. And then the obligations tends to be more often obligations around liabilities. Okay, so again, the stuff from ABC that we learned about control, when can you recognise an asset, something you control, that comes into play. Completeness, again, have we recorded all of our assets and liabilities? Now, usually, companies like to record all their assets, but what they try and do is they try and under-record liabilities, right? Over-record assets, under-record liabilities is 99% of times what management are trying to do. Valuation is all about those dollars, all right? Why do I use the word valuation instead of the term accuracy? It's because assets, liabilities, and owner's equity are typically a lot more complex than your average sale transaction. Right? You sell a good for $20, good goes out, $20 comes in, that's easy. But imagine if you are costing a product. It's not just direct materials, direct labour. There's overhead. How are we allocating that overhead? If I've built a new building, all right, so UTS has a number of new buildings. Frank Gehry building, I think, or the Dr. Chow Chek Wing building, I think last estimate was like $180 million, right? Plus fittings, plus inspections. You know, when you buy a piece of property, plant and equipment, it's not just the contract price you paid. It's delivery, it's installation, it's testing, it's setup costs, and then those all need to be depreciated over time, which is why we use the word value, because it's a little bit, it takes into account that complexity rather than just accuracy. Now, allocation is more about being, oh, hang on a second. Let me use the eraser down there. And I'll use the texter just because it's easier. Allocation is more about having current versus non-current. So, you know, current versus non-current assets, liabilities. Centro got in trouble with the allocation of its liabilities with PwC. Can anyone think of any situation in which you would have non-current inventory? You know, Woolies, obviously, most of our inventory is current. I'd be worried if I was buying an apple that was more than 1 year old. Theoretically possible with their storage techniques. But can anyone think of a sort of industry where we might have inventory that we hold on to for a long time before we sell it?
Cars.
Cars, potentially, especially if you're in vintage cars. Yeah. What else? Whiskey, absolutely. So, former student of mine now works for Diageo, which is a major alcohol label, and they have lots of non-current inventory, especially same wines. So if you're auditing Penfolds, you'd have lots of non-current inventory in terms of grange sitting in there in the bottles. And most wines need to age for at least a year. So, you know, how do you figure out when inventory becomes current or non-current? That's quite a tricky situation. The other one might be if you have antiques or art. So those are the other sorts of things that you might have as non-current inventory. An art gallery might invest in a hot artist now. They might not be selling for very much on the hope that they may pass away unexpectedly, thus driving the value of said art up through the roof. But we've got valuation and then allocation. So most of the time, current versus non-current is pretty easy. Inventory mostly tends to be current. Property, plant and equipment tends to be non-current. But there may be some little tricky bits here and there. So how do all the assertions fit together? I've got this table here where I've tried to match up the assertions. And you'll actually find the assertions in ASA 315. Oh, I've already put the paragraph down there. Sorry. I'll erase that. Down here at the bottom, ASA 315, paragraph A124. Now, I want to bring up the fact that we have an A paragraph here. That means that technically the assertions and following the assertion approach is not legally enforceable. However, the assertion approach to auditing the financial statements is current best practice. But they haven't put it in the numbered legally enforceable paragraphs at this stage. But worldwide, this is what everybody's doing. So, you'll notice that I have some lines that are close to each other. So occurrence and existence, same sort of thing. Real transactions. But I use the word existence for assets and liabilities because grammatically it's a bit weird to say, did this asset occur? Theoretically, you could, if you're thinking about time and space, you might say that an asset occurred, but it's more grammatically correct to say that it existed. Now, you might notice that completeness is the same on both of those. So all transactions, all balances. I've got accuracy and valuation. Those two are quite similar. Allocation is more appropriately matched with classification because it's more about that distinction of how things are recorded within the financials. And then cut-off and rights and obligations aren't exactly the same. This is the correct period, and this is do I own the asset or do I have the obligation? So they're sort of spare on their lines on their own, okay? But this, knowing this, is really, 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 really critical. Okay, really, 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 really important. So it's a good idea if you've not got a great memory like I do. I actually learnt these by writing them on a big Post-it note and putting it everywhere. Bathroom mirror, on my favourite snack in the fridge, so that every time I'm an eating procrastinator, so if I'm procrastinating, I open the fridge to get something to eat. There's the assertions right there. If you're really keen, I've seen students save it as the screensaver on their phone, like when you lock your phone. There it is. I wouldn't do it permanently forever, but if you're having trouble remembering, that's a good place. But these are going to drive the rest of our experience in this subject. So really, really crucial to get it down. And I've gone through this again in a couple of different ways on YouTube as well. So the assertions is probably, besides the bank reconciliation one, the videos on assertions are probably the most watched ones on there. Somebody asked me the other day, because we've hit more than 450,000 hits on our YouTube channel, and someone said, what am I going to do at 500,000? So apparently I have to think of something special to do at 500,000 hits on YouTube. So if anybody has any good ideas, let me know. A weird challenge of some sort, I don't know, eating a chili while reading the auditing handbook. If you've got any cool ideas, let me know, and I'll do something special when we get to 500,000. Now, the auditing handbook also talks about a third set of assertions around presentations and disclosures. And this is really how is everything laid out in the actual annual report. All right, so this is notes to the accounts and the actual layout itself. Now, the reason that we're only going to touch on it today, and I'm not going to spend lots of time on this, is because this is a job that's often done by slightly more senior staff on the audit. So as a graduate or as a vacationer, you're never going to be testing these assertions. So I focus this course on what you need to know to be able to hit the ground running at a graduate or vacation audit job. We do talk about some of the things that you'll look at when you get to a more senior level, but I'm not going to go into heaps of detail. But realistically, this is about making sure that in all aspects, the client is following the AASBs for all of their disclosures. Right? So that's, are the disclosures adequate? Have they put all the right information down? So that's what the assertions are about. And when I flick to the next slide, you'll notice that most of these we've already seen before. All right, so occurrence, we've seen as a transaction assertion. Rights and obligations, we've definitely seen as a balance assertion. Completeness, we've seen as a balance and transaction assertion. accuracy and valuation are all about that dollar value amount that are properly recorded. The only things that are new for us are these here. Classification, classification actually we've looked at before. But understandability is the new one. All right. So understandability here, it's appropriately presented and described. Disclosures are clearly expressed and understandable by the user. Now this is certainly quite interesting because the AASB and a number of reporting bodies around the world are pushing for less information in the notes because they think at the moment the notes to the accounts is filled with too much junk. All right? And it's quite common that a company will need a note 1 year and then the next year they put it in because they forget to take it out. I've also heard of some clients they've got some sensitive information they want to put in the notes that might be a bit controversial, so they bury it amongst lots and lots and lots of other irrelevant information in the hopes that nobody's actually going to go looking. I have some former students who work in the investment analysis type of field, and often they'll be like, if the notes get too long or it starts to get too boring, I just skip to the next one, which is exactly in some circumstances what management want you to do, rather than find the juicy, exciting information that they've squirreled away somewhere and the auditor has said disclose it, but they've just buried it in loads and loads of just crap. So that's something that'll be interesting moving forward as to how, as auditors, we help them streamline, how we help them determine what's material and what goes into the reports. All right, evidence. So again, this is like the fingerprint, the blood spatter, the DNA report. I need to gather a sufficient, appropriate amount of evidence to be able to give my opinion. Whoops, wrong thickness of the pen there. All right. Here is where it gets tricky. The amount of evidence that is sufficient relates to quantity. All right. It also says that evidence must be appropriate, and appropriate relates to quality. But ASA 500 nowhere says how much is sufficient or what sorts are the correct quality. Instead, the standard does the age-old chestnut for auditors, and it says you must rely on your professional judgment. All right. That is how we figure out how much evidence is sufficient and appropriate. That's like a really nasty way of saying there's no 100% correct answer. Now we know as auditors I'm not giving a guarantee. I know that I can't test every single transaction, so I have to figure out how much is enough. Is it 5? Is it 50? Is it 25? Is it 5,000? At PwC, we used to have this rule that you'd always start with 25. I don't know how 25 is the magic audit number, but I've noticed in some other audit textbooks, when we talk about how much to collect, they always say start with 25. I don't know who chose 25 or where 25 comes from, but we have to use our professional judgment to figure out how much is enough and what sort of evidence we're going to collect. This part here about appropriateness comes down to design. Designing ways to collect the right evidence. And then sufficiency is knowing when to collect more and when to collect less. We're not actually going to go into the mathematics of how to calculate sample sizes, but I'm going to talk about when I want you to collect more and when you should think about collecting less. Every firm has its own little mathematical formula where you click some buttons within the audit software and it spits out 10 or 25 or 50, and then you move on from there. So what do we do in terms of evidence in the audit risk model? Obviously, when risk is high and my risk of misstatement is higher, detection risk is low, and I'm planning a substantive approach to the audit. Here, I'm going to collect a lot more evidence, right? That seems really logical. More risk, more chance of misstatement, collect more evidence. All right. Then, our other alternative where risk is low, I'm going to do a controls-based approach. Now, I know that the textbook says lower assessed level of control risk approach. That's a mouthful. Nobody in practice actually says that. Everyone says, let's take a compliance or a controls-based approach. Those tend to be the two terms that are used. Now, we are going to collect less evidence here, but the evidence we're going to collect is going to be more about the internal controls of the company. Whereas in this one, we're doing lots of detailed checking of invoices and bank statements and shipping documents, and you're going to collect a lot of it in this one over here. This one's more expensive as well. There is a great YouTube video on selecting your audit strategy where I actually draw a diagram and I put risk on a continuum and I sort of show you how much control testing and how much substantive testing we do in various situations. Now, what happens when I'm in the middle and I end up with medium as my detection risk? Well, when I end up in a situation where I've got medium, I'm actually going to do a combination of substantive tests and tests of controls. Okay, so if you ever get stuck in that medium section, that's what we're going to do. All right. Okay, types of evidence. Now, I am not so fussed about types. Okay, so we're going to briefly go over types, but I don't want you to stress over knowing all the different types because it's more important that we learn about procedures here. Little link to the YouTube video is a YouTube video on confirmations. I used to actually ask a homework question about this. I don't anymore because the video is quite comprehensive. But a confirmation is like asking an external referee for their opinion. Go to the bank and say, independently tell me how much money is in this person's account. All right? So I can do it with the bank. That's the most common one. The second most common, so the first most common is the bank. The second most common is the debtor's confirmation, where we write to customers and say, is this how much you owe? Confirmations tend to come in two forms, negative and positive. Negative says, reply only if the information is incorrect. The reason that is a really bad idea is that you're going to make the assumption that the information is correct if the company is closed down, or if they've moved offices, or they just can't be bothered to reply. You're going to assume that the information that you've sent them is correct. The positive form is reply under all circumstances. Now, the issue with any form of confirmation, especially the debtor's confirmation here, is that usually only 10% of people actually write back and say, hey, here's our actual balance. The rest, throw the letter in the bin. So you still have to get evidence for those other people. We're going to talk about how you do that. So the confirmation, is my opinion that the confirmation is a really outdated form of evidence collection. And a number of years ago, I asked an audit partner, look, why are we still doing confirmations? When they're lengthy in the video, you'll see that I talk about how much time it takes, and how much in terms of resources it takes. And the partner response was, it's tradition. Like, we did it last year, and the year before that, and the year before that, and the year before that, so we're going to do it this year. And it's a really shitty answer, to be honest, because we're going to learn about some other procedures later on that will allow us to confirm debtors without having to contact them, and we can do it in less than a day. And it's so much more efficient. But auditing, like many things, has its idiosyncrasies and its traditions that we always do. The bank confirmation, though, something you'll always definitely do. You do it online, actually. In the old days, you went to the bank and you filled out a form and you paid a fee to get a letter from the bank that confirmed the amount. You still pay a fee now, but it's all done online. So you submit an application online, they go away, contact the bank, get it, and send it back to you. And depending on the size of company, they used to be as cheap as $10. I think the cheapest price now is about $40, but they can get very expensive if you're asking for a lot of bank accounts, if a company has a lot of accounts in there. All right, documentary evidence. And here is where I say, for all those people who are already auditors or have done some audit work, you know that the Band-Aid is the most important kit in your audit piece of equipment in your audit toolkit, because you spend a lot of time looking through boxes and piles of paper for invoices, for bank statements, for delivery documents, for contracts. So the paper cut is obviously the biggest risk occupational health and safety wise that the auditor faces, besides the very long nights and the overdose of sugar and caffeine. But I thought it was a joke when my senior gave me a packet of Band-Aids on my first day on an audit, and he was totally correct, because there's nothing worse than getting a paper cut and then getting another paper cut across an existing paper cut. Has anybody ever had that happen? No? It's bad. Worst audit injury I've ever had. It just really, it's terrible. And you know, what's worse is the paper cut here in that sort of fleshy part where you've got to move your hand all the time. So documentary evidence we look at a lot of. The trick is it authentic? Is it real? Is it genuine? Is it reliable? And that's something that we'll look at a little bit later in terms of persuasiveness. Representations are letters that are sent to the auditor that are like a written confirmation of what somebody says verbally. So the management representation letter is that when management tell you information that they don't have any other documentary evidence for, they tell you and then they write it down in the management representation letter and then sign it to say, like, this is like a statutory declaration of what we tell you is the truth. You can also get them from lawyers as well. There's verbal evidence. Now, in AWA v. Daniels, that legal case, this is where the auditor came unstuck. Never, ever, ever rely on verbal evidence as your only source of evidence. All right? Always back it up or corroborate it with something else. Because people lie. Now, I'm not going to assume everybody's lying, but we know that management always want to put a positive spin on something. They might not tell you the whole truth. So never, ever, ever rely on verbal evidence. You'll always start with people telling you things, but then always back that up with something documentary. Computational evidence, physical evidence, all different types. Now, I can't actually play the video, but in the video, Fiona Campbell from EY talks about how when we have only verbal evidence, it's always good to get a management representation letter. I'll see if I can find the link and put it on YouTube line for you. All right. You've also got electronic evidence, but the funny thing is, at the majority of clients, we can't take a piece of electronic evidence away. So most often the client will take the electronic evidence and then print you a copy for you to keep, which is sort of a bit hilarious. Sometimes if the evidence is not easily visible, you may need to get your IT audit staff in to request special access so that you can look at audit logs and security codes and things to make sure that you get the evidence that you need. All right, persuasiveness. This is all about, is the evidence reliable? Do I think it is trustworthy and that I could use it to make my audit opinion? All right, so my job is to corroborate my transactions, and evidence has different levels of persuasiveness. Now, the one, and I'll do this in different colours so that it's easy to see, most persuasive, externally generated evidence that goes straight to the auditor. All right, so this is like asking the bank to send us a copy of the bank statement so that we get exactly what the bank has, not what the client has that they may have photoshopped for us. So, the middle persuasive is externally generated but held. Ooh, undo. I meant that to be the highlighter. Yeah, here we go. Externally generated but held by the client, because they do have the option of photoshopping it and then replacing it before they give it to you. I've seen that before on some bills, and we thought they looked a bit different from the supplier. And I knew that supplier was also a supplier to a different client. And I looked at the invoices, and they weren't quite exactly the same because there'd been some Photoshop involved. And you can often look at paper quality, all sorts of different things. And the things that are the least reliable, but still something that I'd want to consider, is evidence that is internally generated. All right, and that's invoices, all sorts of stuff. So let's look at the internally generated evidence. Checks, invoices, documents. It is open to manipulation. If you do have internally generated evidence, what you might try and do is triangulate. Take two sets of internally generated evidence on the same thing made from different systems and check if they're telling you the same story. All right, so that's one way, because we do have to use a lot of internally generated evidence to get some reliability. Externally generated, which was the ones that I had as the orange color there, externally generated held by client. I want to see originals more than photocopies. If a client says, I'll make copies for you, you say, no, I'll do the copies. Quite often now, in the old days, we had to keep paper copies of everything. Now I know that on audits, most of the time someone brings a scanner and they just scan the documents in, which is great. But the client still could omit information or tamper with it. Right? It's pretty easy to forget that a bill ever came and stick it in the shredder. And then the one that's the best is our externally generated and, most importantly, sent directly to the auditor. That's the key one there, sent direct to the auditor, because it's independent of the client. All right. Now, sometimes we may find ourselves in a situation where I don't know all the facts, or I don't know how to interpret all the information that's given to me. A good example there is, for a lot of audit firms, the mining industry. All right. Now, firms are obviously organised by speciality, so they have finance teams who specialise in financial services firms. They have CIP, which is CIP, quite often, consumer and industrial products. They might have services, then they have mining or government. So they're organised by industry because they're a special industry knowledge that everybody needs to have. Now, even if you're an auditor in the mining industry, unless you've got a science degree or a degree in geology, you might not know how to read the geological reports that a company relies on to predict how big a mineral reserve is underground. All right? So in that instance, it's quite common to use the work of an expert. So you would hire an expert who's well-renowned, who's independent in the field, who can give you an opinion on what does all this jargon say and how do I translate that in terms of my audit. All right. Now, certainly some firms, at one stage PwC was hiring science graduates and then teaching them auditing to try and save some money on expert fees, but you still will sometimes use experts under ASA 620. So if you use an expert, you need to consider, do we have the right knowledge? What does the expert have to do? Are they actually an expert? Have they done this for other clients before? We often choose experts as people who testify in court cases. So if the government says, oh, look, you're a good person to testify as an expert on this, then they might be good. So using an expert is quite common. We can also use the work of another auditor. And something that we haven't really talked about much, or doesn't get talked about quite often, is the idea of a component audit. So think about QBE Insurance. We've heard of QBE Insurance, multinational Australian-based insurance company. They have subsidiaries all around the world, and they have an audit team based here in Sydney. The way that our group audits work is that the Australian audit partner is responsible, theoretically, for all the audits that happen in all of the subsidiaries all around the world. That's risky, right? So when we have auditors in other locations, and that locations may be other countries, it's usually other countries, then we need to think about using a component auditor. Now, the appeal of using a Big Four or an international second-tier firm is the idea of a network firm. So obviously, PwC in each country has audit partners in each country that specialise in their jurisdiction. So the PwC partner in Australia will hire PwC will instruct the client to hire PwC in New Zealand, in Fiji, in Singapore, in Hong Kong, in the UK, in the US, to do those audits of those subsidiaries and then send their reports into the head group auditor. All right. The beauty of the network firm is that theoretically everyone should be using the same audit methodology. And for those people who have Kate, Kate replaces Owen Baker, who was teaching here for about 5 years. And Owen has moved to the UK to be the Australian representative to help Grant Thornton work out new audit methodology. So they've taken representatives from all around the world to make sure that everybody is on the same page about how they're going to run their new audit methodology and then teaching that to people. And I think he's there on like a 3-year project. So it's a big thing that's going on. So the network audit is a really great reason to go for a big firm. What if you're somewhere where there is no network auditor? You have a subsidiary in Zimbabwe where there might not be PwC. Well, if there's another Big Four firm, you might rely on another big network because that's quite reliable. But what if you're somewhere where there is no Big Four firm, no international firm, you just rely on locals? That's where you have lots more risk, all right? Because you don't know whether those local auditors are trained to understand international accounting standards, to understand the accounting framework that you're using. So in that situation where you can't get your network and you can't get a Big Four firm, I've heard of instances where the Australian parent group will actually send one auditor or 2 auditors to supervise the small audit firm in that other country. A really good friend of mine who's a vice president at News Corp now, but when she used to work at EY in New York, one of her most terrible jobs she ever had to do was go to Barbados for 2 weeks to supervise local auditors there. She's like, it's terrible, you know, they work like a 9 till 4 work day, and then there's sunshine and snorkeling and beaches. I thought, oh, that sounds so miserable. So you may have to go and supervise as a component auditor. One thing that hasn't really been discussed in any textbooks, but I'm going to bring it up because this is going to be an important thing moving forward, and I'll create a new slide actually. New slide. Is the idea of outsourcing audit work. All right, and we know that outsourcing of audit work does happen. So what is typically happening is, you know, you've got auditors in Sydney, okay, and the auditors in Sydney go out and they collect a whole lot of documentation for the audit. All right, they scan it all in. But what they need is somebody to check all of the documentation. Is this calculation correct? Has this been done correctly? Does this match up? And let's say they have a second set of documents over here, and they have to match some of these ones to details on these ones. Typically, in the old days, that was the work of the graduate or the junior or the vacation auditor. Now what we have, and what we see almost I'm pretty sure all the Big Four are doing this, is an overnight service in somewhere like India or the Philippines. But it's mostly India, Bangladesh, because salaries are lower. The time zone works out a little bit better. And so what the audit firm actually does is they take these documents and they send them overnight, where you have in India lots and lots of auditors working for a quarter of the pay that you're paying your auditors here, and you'll get them overnight to do all of that work and then send back a finished report. Goes back on, here's our findings, here's a summary of all the testing. Okay. Now, is there a standard that deals with outsourcing? No. and when outsourcing first started, it was a nightmare, right? You would send stuff to India and they would do all sorts of weird things. You didn't know if they were looking at the work correctly. And what the big four firms have started doing is they started sending staff from Sydney to oversee the work that happens here. All right? And that's, I've heard of people being told that, if you want promotion quicker, one of the things you want to do is you want to take a secondment to our overnight processing service, all right, where you will supervise hundreds of auditors doing grunt work, essentially, or the hard labour part of auditing overnight and making sure that they're following international rules, international procedures, and then reviewing the report before it gets sent back to the auditors in Sydney so they can use it to further the audit. All right, this is cost saving at its best. Is there a standard that really covers what's going on here? No. Could this be covered under the component auditing process? Potentially. But this does create some issues. I don't know whether clients are pushing for this or whether firms are doing this proactively. I know that I think it's PwC's expenses process for claiming expenses is now all outsourced to India, and somebody claimed like 35 kilometres from the client to the office, and someone in India had said, look, Google Maps says that this route at 33 kilometres is shorter. Why didn't you take that one? I'm not going to pay you the 2 extra kilometres because of blah, 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 blah. So certainly there are some issues because they're following very technical rules. Whether that impacts the quality of the audits, we don't know. Firms don't disclose any information of how much of this outsourcing is going on. So we have a lot of anecdotes. We have a lot of off-the-record sort of information from partners and from people working in audit firms. But the firms are being very tight-lipped about this. If it's providing them with commercial efficiency and ability to make more profit, I can understand why they're not telling us about it. But I can perceive that there are risks associated with doing this. All right, this is like Telstra and the automated thing where you speak into the phone about what your problem is, and then it tries to transfer you to the correct department, and then you just get frustrated. I don't know whether the same might happen. Okay, how do we gather evidence? All right, this is the thing I want you to know about. All right, so big, important. Okay, these 9 things are really 9 things that we're going to talk about from now until the end of term. So, I'm pretty sure there's 9 procedures. 1, inspecting records or documents, looking at stuff, right? Number 2, inspecting physical assets or tangible assets. Please remember you can't inspect an intangible asset. You can't look at goodwill. Number 3, observing client staff. Now, there's risks in this. Just like, who was a bit of a messy child? That was me, right? I was a messy teen and child. And my mum would come into my room and she would say, clean up this mess. And she would stand there with her arms crossed, giving me the nasty mum look, right? And she would watch me fold stuff. And so while she's watching, I'm folding stuff neatly and I'm putting it back in the drawers where it's supposed to go. And I'm taking the books and I'm putting them on the bookshelf. And then when she thinks that I'm on the right track, she leaves the room. And when she leaves the room, I just start shoving stuff in drawers and then shutting the door, and then that's it, right? I'm done on cleaning, right? Or you shove everything under your bed or into your wardrobe and then shut the door and hope she doesn't open it. So that's the idea that when people are being observed, they're doing the right thing. When you stop observing them and no one's watching, then they're more likely to go back to their shortcuts. So observation is good for sort of finding out what people should be doing, but it's not great to figure out whether they've been doing it correctly the whole year. Unless, of course, there's a video camera over the accounting staff 365 days a year. But as an auditor, I'm not interested in watching an accounts payable clerk for 365 days. Right? It's not terribly exciting. So observation is good at the beginning to sort of get a feel for what's going on, but you're not going to use it as a main source of evidence. Number 4, the inquiry. This is where most people start. All right? And this is the reason why the audit firms say, I can teach a monkey auditing, but what I need is good communication skills. All right? You're going to need to talk to people to find out about what's happening in the client, what has changed, is there anything I should know about? People aren't going to say, hey, you're the auditor. Can I tell you about a fraud that I've been engaged in the last 12 months? So inquiry combined with careful observation is really important. One thing that I would always do when I would go to clients is that when I'd have to meet someone, I would never have the client come to me in the boardroom. I would always go to them in their workspace. All right? That way I can see what the workspace looks like. Are they messy or clean? Do I see pictures of kids? Do I see pictures of dogs? Do I see sporting equipment? Do I see holiday photos or fishing trophies or something else that might give me an in to allow me to start a conversation on a personal nature to create a personal connection? Right? Clients don't want to help you at audits. They want to do their own work, and the auditor coming in is like the most annoying part of the entire year. Does anybody work in accounting and hates that time? The auditors are always asking for information, and if they're not nice about it, the client will drag their feet. Oh, you needed those reports yesterday. It's going to take me 2 weeks to generate those. I'm really sorry. So you need to create a rapport with your clients. Sometimes they might tell you information that they wouldn't normally tell you if they think you're friendly and you're getting on well with them. So I know nothing about footy tipping, but if I see that and someone's really involved in it, I'm going to go off and do some research, right? So that on Monday mornings I can strike up a conversation about how about those Rabbitohs or whoever. I'm not really into football, but I know Mario and Steve Fennick, the Fennick brothers, so Michael, Mario and Steve, I know. So I know a little bit about football, but not enough to get into a real conversation. But if I see running shoes, I heard the Blackmore's Running Festival is coming up. Are you guys getting involved in that? Have you guys got a corporate team? So most of what you're trying to do is to create a connection. And a lot of times people think, well, what does that have to do with auditing? That's like Spycraft 101. Yeah, is creating the personal connection, finding out how you can access the information, making the cold approach. Yep. So the inquiry is really useful, but it's not going to be your only source of information. And people have different approaches. I have a friend who's no longer at PwC. She is model-like in look. So she's tall, she's blonde, she's curvy. And she was assigned to mostly male-dominated engineering firms. So her best tactic was dumb blonde, right? She would play the stupid, could you possibly get that information for me? And these men at these engineering firms, married, sensible people would fall over themselves to give her access to information that perhaps she might not need for the audit, or could tell them about something that was going on that they might not need to tell her about. Or, what happens if someone's sick? If the person who needs to approve this is sick, we just go to their drawer and there's a post-it note that has their password on it. Now, that doesn't work for everybody. I found being friendly and approachable and, seeing what people are interested in. Oh, God, you have a dog? I love dogs. Right? Where do you guys go for walks? I found this, my dog loves this treat the best. At the time, I didn't actually have a dog, but it's amazing how well you can do research online to create that connection, to be able to build that relationship. Recalculations, that's really easy. This is like the Excel math stuff. Reperformance is do what the client did. Analytical procedures. Now, this is the sort of stuff you guys will be doing or have done in FSA. In the homework, not in the homework, in the Cloud 9 this week, it says do some analytical procedures. I'm never going to get you to do the calculation. Right? Never, ever, ever going to get you to do the calculation. I will always give you the calculated ratios and then say interpret. And your tutors today have been told just put up the ratios for the students. Don't worry about calculating them. I'll actually put up a copy of that online as well so that you can see it for this week's Cloud 9. But the AP stuff is critical in trying to give a signal, right? It's like the radar from far away. It flags and says, hey, something looks suspicious here. And then vouching and tracing. Vouching is starting at the end of the transaction and working backwards. And tracing is starting from the beginning and going to the end. Okay? I would strongly recommend that everybody watch the video on the differences between the two, because there's some very crucial reasons why you use one or the other in various situations. But these 5, 6, 7, 8, 9, these 9 procedures and the assertions from today are critical. All right. So, in Microsoft Project, if anyone's ever used Microsoft Project at work, you have those critical milestones. This is one of those milestones you need to have down. Understand the audit risk model, and then learn the assertions and the procedures. All right, because this is going to come back every single week to haunt you. And I'm going to nail you guys on this every single week from now until after you sat the exam. Because I'll probably still be talking about it in the study period. Okay, so we've done all of that this week. I just want to quickly mention the midterm. Has everybody looked on My Subject Activities for information about the midterm? Yes? No? Friday the 25th of September at I think 9 o'clock. So it's only a 2-hour exam. Next week there will be a little video that I'll put on UTS Online that'll tell you everything you need to know. It's multi-choice only. There's lots of practice multi-choice online, but I'll make a little video for you guys where you'll get all of the information, how many questions, all of the rest of it. Does it have a location yet? Wentworth Park. Okay, all right. Well, at least it's the daytime. They had us at like 6 o'clock at night last time. So I actually won't be around during the study vacation week, but Nelson will be running all my consultations, and I'll be checking in on the discussion board periodically. I've been told I have too much annual leave. So I'm taking my 2-year-old to Disneyland. We're going to California. We'll do LA, San Diego, and Anaheim. So I will be away, but if it's an emergency, I'll still be contactable. But keep an eye out for the video next week. Thank you, everybody. Enjoy your tutorials tonight, and I will see you all next week.